The stock market has always been subject to fluctuations and volatility, and investors have learned to navigate its unpredictable nature. However, recent concerns about a possible stock market crash in the United States have sparked alarm among investors and financial experts. While no one can predict the future with certainty, there are indicators that suggest a potential crash could be on the horizon. In this video, we will explore the factors that could contribute to a market downturn, as well as the steps investors can take to mitigate their risks and protect their investments. So, fasten your seatbelts and join us on this insightful journey into the world of the stock market. When a stock crashes, it's the result of economic circumstances that have caused investors to behave in terror. Such financial crises have occurred regularly throughout our history. Stock market collapses were chronicled in the United States as early as the 18th century, and serious financial downturns have had a place in America's history since then. The recent statement by Federal Reserve Chair Jerome Powell indicating that the central bank may continue to raise interest rates has sparked concerns about a possible stock market crash in the United States. There are several factors that could contribute to a market downturn in the US. Here are some of the most significant ones. A market collapse in the United States could be caused by rising inflation. Inflation happens when the costs of products and services increase over time, which can diminish the purchasing power of customers and harm the profitability of businesses. As the cost of living increases, customers may limit their spending, which could lead to a decline in demand for goods and services. This may negatively affect corporate profitability, which may result in lower earnings and stock prices for the company. Additionally, increased inflation may result in higher interest rates, which may raise borrowing costs for both consumers and businesses. The profitability of firms and the stock market may be further impacted by a reduction in investment and spending. It's important to note that some inflation is normal and even desirable for a healthy economy. However, if inflation rises too quickly or is too high, it can have a detrimental influence on the stock market and the overall economy. In order to reduce potential risks, investors should monitor inflation rates and modify their investing strategy as necessary. Another major element that may cause a market slump in the United States is geopolitical tensions. Trade disputes and political instability between the US and other nations, including China, can have a knock-on effect on the world economy and the stock market. The profitability of companies that depend on international commerce, for instance, may suffer as a result of tariffs and export and import restrictions brought on by trade disputes between the United States and China. This could lead to a fall in company profits and, in turn, a decrease in stock prices. In addition, political instability in other parts of the world, such as violence or regime change, can also affect the global economy and the stock market. For instance, Middle Eastern unrest may have an effect on oil prices, which may have a substantial effect on the world economy and the stock market. It's crucial to remember that geopolitical tensions can shift quickly and are frequently unanticipated, making it challenging to predict how they will affect the stock market. However, investors can follow political changes and adjust their investing plans accordingly to reduce such dangers. Investor confidence and market sentiment have also impacted the stock market. If investors become overly pessimistic or optimistic, it can lead to a sell-off or buying frenzy, respectively. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Powell said in remarks prepared for delivery before the Senate Banking Committee. McDonald argued that for every 1% increase in rates, $50 billion is taken out of the pockets of middle-class families. The expert noted that auto loan rates are currently close to 14%, and that over 20% of auto loans have monthly payments of $1,000 or more. As a result, middle-class families are suffering in this area. One of the market analysts has expressed concern that a crash could occur within the next few days. When the Federal Reserve raises interest rates, it can increase the cost of borrowing for firms and consumers, which can lead to a decline in spending and investment. This can damage the profitability of businesses, which can, in turn, lead to a reduction in stock prices. A higher currency may result from rising interest rates, which could reduce the competitiveness of American exports and have other negative effects on the economy. The global economy and financial markets might be significantly impacted by a market crash in the United States. The precise impact will depend on the magnitude, length, and underlying causes of the crash. In general, a market crash can result in a considerable drop in stock prices, which can have an effect on investors' wealth and financial security, as well as the success of their enterprises. This can lead to a decrease in consumer spending, which can further impact the economy. It can also have a rippling effect on the financial system, as investors and financial institutions may be obliged to liquidate assets to satisfy obligations, which can lead to a downward spiral in prices and more instability. This may have an effect on the finance and credit options available, which may have further effects on the economy and enterprises. A market meltdown can also result in greater unemployment, social unrest, and political instability, which can have wider social and political repercussions. Given that the United States is a significant player in international trade and finance, it may potentially have an effect on the world economy. Despite these concerns, it's important to remember that the stock market is inherently volatile, and it's impossible to accurately predict market movements. However, there are steps that investors can take to mitigate the risks of a potential market crash. Diversification and risk management are key strategies for minimizing losses in the event of a downturn on the market. It's not possible to completely prevent market crashes from occurring, as they are a natural part of the market cycle. However, there are some measures that the US government and regulators can take to help reduce the severity and frequency of market crashes. The government can implement regulations and oversight to ensure that the markets operate fairly and transparently. This can include regulations on trading practices, reporting requirements, and the use of leverage. Government can also take steps to stabilize the economy during times of market stress. This can include measures like monetary policy, fiscal stimulus, and other economic support measures to help mitigate the impact of market crashes on the broader economy. As we wrap up this discussion on the possibility of a stock market crash in the United States, it's important to keep in mind that the stock market is constantly changing and can be affected by a multitude of factors. While there may be concerns about a potential market downturn, it's important to remain calm and approach investing with a long-term perspective. It's also recommended to seek the advice of financial professionals to help guide you through any potential challenges and develop a personalized investment strategy that aligns with your financial goals. Remember, the stock market can experience both ups and downs, but staying informed, prepared, and diversified can help you weather any storm. By keeping a level head and staying focused on your long-term goals, you can navigate any market fluctuations with confidence. Thanks for watching. If you found this video helpful, please hit the like button and consider subscribing to our channel for more great content.